obviously this type of question, I'm sure you can understand that it's, we could probably spend like 4 hours just looking at that question alone. So it's a pretty meaty one. So I'm just going to give you a broad overview. Otherwise it's probably worth an hour or two going through every single one in a lot of detail. But let's just quickly look at what exactly is leading, coincident, and lagging indicators. So for that, let me quickly pop this chart on the screen here. Let's do this. Just give me something to draw on here. Let's move this away. So let's pop in a sine curve here for a sec. If I can just find the right one here. Where we go. That's it. That's it. All right. So let's look at a sine curve. So imagine this is the economic cycle. So the first thing to note, there's differences in the types of cycles that we look at. So the more broader ones, the bigger ones that runs for a couple of years, maybe 5 to 10, that's normally considered as your secular cycles. Then you also get something like the medium term debt or business or economic cycle. And then there's also these smaller cycles, which you can think of it as growth and inflation cycles, sometimes called the cyclical trend, or the if we say that the current cyclical environment we're in, we're normally referring to what's happening to growth and inflation. Where is growth now? Where is it expected to go? Where is inflation now? Where is it expected to go? So there's various different cycles, but let's look at a basic cycle, and let's look at a business cycle here. Let me just grab this out a little bit longer. So what you have in this chart, you can see that the various phases of the business cycle. Over here you have what we call that the early stage recovery part of the cycle. So that is when the economy has just gone through a slowdown, it's just bottomed out, and it's starting to make its way back to the upside, seeing first signs of growth, if that makes sense. Then you have the actual expansion taking place, which can take a very long time. It's something that normally takes much longer than the initial bottoming out process. We normally call this the mid cycle. Then you go through the late cycle, which is this one here on top, where the economy is starting to lose some of that initial strong recovery momentum, starting to show some possible signs that maybe there's a slowdown coming. So that is what we call the late cycle. And then obviously you go through the other side of it, which is the actual contraction. Then you go into if you go into the bottoming process, this process isn't always associated with a recession. Recessions basically just means that you're going into negative growth territory. So if you imagine this is like a line, and over here you've got positive growth, over here you've got negative growth. You don't always have to go there, right? A slowdown can also start recovering before we go into an actual recession, which is important to keep in mind. So, but think of that as the overall business cycle, with your early stage recovery, your mid cycle, late cycle, and your contraction. Let me just hide all of these. So the reason why I want to explain it from this part is it helps to see where these different leading, lagging, and coincident indicators fit in. Now, if you consider the first one a leading indicator, what we mean by a leading indicator is that a leading indicator normally leads the economy, meaning that let's say that we are in a contractionary phase, right? Let's say that we've been slowing down, the economy has been slowing down, not necessarily in a recession, but growth has been slowing, inflation has been slowing, and eventually we start getting some positive leading indicator data. That's data that could start to show that the economy is starting to bottom out already. It's leading the economy, meaning that the broader economy is still slowing. Overall aggregate demand is still slowing down. We're still seeing clear signs of a slowing economy, contracting economy. But leading indicators will be the first one to react to the positive side of things. It'll be the first one to say, hey, maybe we are seeing a little bit of a recovery. Similarly, a leading indicator will be the first one that shows us there's trouble ahead. While the broader economy might still be in the late cycle, or late in the cycle, your leading indicators will already have turned around and started to tell you, hey, there's problems here. Things are starting to look a little bit less rosy. So think of a leading indicator as just that it leads the economy. You're going to see your leading indicators turn up or down before the broader economy turns. Then you get to the second one, which is coincident indicators. Now that is things that those are indicators that moves alongside the economy. So once the economy has bottomed out and started to recover, you would expect coincident indicators to track the economy as we are in the early cycle. You would expect it to show mid-cycle signs. You would expect it when the economy is there. You would expect it to show late cycle signs when the economy is there, and you would expect it to show contractionary signs when the economy is there. So coincident moves with the economy. Then you get the lagging indicators. Now, the lagging indicators is just the exact opposite of the leading one. That means that that normally reacts after the economy has moved. So let's take a early stage recovery, for example. We can already be in a recovery, a early stage or early cycle recovery based on our or let's say the broader economy is now in a early cycle recovery, just hypothetically, of course. You would expect your leading indicators to already be somewhere over here. You would expect your coincident indicators to tell you, yes, we are busy with recovery, but your lagging indicators will still they will still be bottoming out. They will still be showing possible contractionary signals. Similarly, once you go through let's say that you are now officially in a contraction. Let's say that your leading and your coincident indicators are telling you, yes, you are in a contractionary period. Your lagging indicators will still be showing you late cycle data. It'll still be showing you late cycle indications. So with that said, what are the most important ones to watch? Let's do a list here. There's quite a few of them. When you take a look at your leading indicators, the first one that you would always keep on the radar is your ISM prints, right? That'll mean your ISM manufacturing and your ISM services. Those two will be very important to watch. The other one, in line with the ISM, is just the S&P Global Flash PMIs. Very, very timely, always good to watch as a leading indicator. Apart from that, you have consumer confidence and sentiment, both of those leading indicators. Then you also get things like your Philadelphia Business Outlook Survey, also considered as a leading indicator. Things like things like your NFIB Business Outlook, that is also considered as a leading indicator. New home sales is another one. Pending home sales, another leading indicator. Initial jobless claims. Also on your leading side, then durable goods orders as well, leading indicator. And then you can also add in things there like your Atlanta Fed GDP. It basically tracks GDP, which is more coincident, but it leads the report, right? So that's also something that you can use as more of a leading indicator. But to show you something about a coincident indicator, if that makes sense. So that will be a good list to start with in terms of leading indicators. Something you can also add in here is when you look at the more international side of things. Internationally speaking, other leading indicators will be things like your IFO business survey out of Germany, your ZEW sentiment out of Germany. Obviously, the S&P Global PMI is also included there. Other things you can look at is the OECD composite, the CLI, the composite leading indicator. Absolutely fantastic for tracking growth, that one. It gets released with a bit of a lag, though. So when we get an update this month for the OECD, for the CLI, it's going to be updated for May. It's not going to be updated for June or the month before. So it's got a 2-month lag, which is the only negative when it comes to the OECD data. But that's also a good one to use. So I think those are really good leading indicators. Then when you take a look at your coincident indicators, remember those are things that moves with the economy. That'll be retail sales, GDP. That'll be things like personal income and consumption. You can actually add in your producer prices here as well, even though normally your inflation matrix is considered as lagging indicators. Your producer prices can actually be seen as a coincident indicator depending on where you are on the cycle. So if you take a look at the cycle, normally producer prices leads into or at least moves with the economy, or potentially leads going into a recession. And oftentimes it lags coming out of a recession, going into recovery. So that's just something worth keeping on the radar. But those are good coincident indicators to have on the radar. Then, in terms of your lagging indicators, the big one, of course, NFP, right? Labor, it's considered as a lagging indicator. It's considered as a late cycle a late cycle indicator. So whenever, if you look at the explanation that we showed for where we are, if in this current environment, we've already been slowing for quite some time. We've already showed contraction, but labor is still doing really, really well. The reason why labor market is still keeping up is because it's a late cycle indicator. So jobs growth is still showing strong. When that starts to really react and employment falls off a cliff and unemployment starts spiking, you are most probably already in a recession. So NFP or labor data considered as a lagging indicator. The other one is CPI. Now I know there's some analysts out there that'll say that it's more of a coincident indicator, but if you take a look at how, if you take a just track it, take a look at a chart of inflation and growth. If you take GDP, for example, in CPI, GDP is released very late in the quarter. So even though it's coincident, it gets released with a big lag. Even that sometimes can start showing signs way before your CPI does. So for me, inflation is more of a lagging indicator, not really a coincident indicator. So I would place things like NFP and inflation data in your lagging indicator camp. Now, there's also some other ones that you can look at, of course. Apart from, and this also comes into the leading indicator side. Apart from actual economic data, there's many other leading indicators that you can use for the economy. The big one, of course, is looking at something like your 2s and 10s yield spread, your yield curve. That's an important one. Equity markets themselves can be a good leading indicator. Not always, but they often react before the actual economy starts to react. So that's a good one to keep on the radar. Equity markets, obviously the copper, Dr. Copper, really good for a estimation of where the global economy, industrial economy is going. Oil prices, not necessarily as a leading indicator for growth. It can be based on what it tells us from a demand point of view, but it's more a leading indicator for inflation. So that's important to keep in mind. Apart from oil prices, CRB commodity index, that's one to watch again, based on inflation, but also, if commodities plummet because demand is expected to fall, that can obviously be a leading indicator for growth as well. So CRB commodity index is one. The other one is watching things like inflation expectations. You will have both growth and inflation baked into inflation expectations. So that can also be a good leading indicator. But these are more market-based indicators. So these are the ones that I normally look at. It's quite a big list, and this is an extensive list, by the way. I might have missed a few. I'll need to go through my setup that I have in Refinitiv. It's quite extensive. There's many things that we look at. But apart from that, in terms of how we actually use it to track the economy, think about it in that sine curve, right? So let me quickly go back there. So if we think about it from a sine curve perspective again, how can we use these data points? Well, if this is your sine curve, right now, for example, how we've used it is, if you go back to the videos that we did already in, I think it was November, I think we did a 30-day challenge at that time. One of the key themes that we were looking, and you can see big risks and opportunities for equities. So the current context, now keep in mind this was January, right? The current context where we have expectations of a slowdown in growth and inflation coupled with a Fed that has just turned very hawkish and aggressive sets the stage for a very volatile couple of months, especially true for equities. Now, again, we didn't have a crystal ball. What we did was we basically looked at what the data was telling us. And the data was telling us that even though your coincident and lagging indicators were still showing, hey, it's a party time, everything is fine, we started to see the leading indicators telling us, hey, we are now past the top. we've topped out. Because if you take a look at those trends that we look at so often in our videos, if you take a look at this, all of these things started to turn around. All of these started to turn lower and show downside momentum for quite some time. So based on that alone, we know, okay, we knew growth was slowing. We just didn't know how much growth was going to slow. So the first way that you can use it is to preempt when you are going through specific shifts in the growth and inflation cycle, and that can obviously determine quite a lot how you position yourself in those types of environments. So using the leading indicators to give you a possible sign of when things might be turning around. And then obviously where we are right now is we have no more question marks about slowing. We know we're slowing because leading indicators are over here. Even the coincident indicators have been showing us, hey, we are now firmly in slowing territory. But we've got the lagging indicators. Labor market is telling us, no, we're not there yet. But we know it's a late cycle lagging indicator. So when this sucker starts to turn around and show us the same thing, then we know, okay, it's game on. We're probably going to start seeing a Fed that sounds a little bit less hawkish when that starts to happen. So that's just one way that you can do it from a more medium-term perspective. Now, from a more short-term perspective, what played out with the euro over the last, let's say, 3 weeks or so is exactly how we use these types of things to tell us, to give us trade ideas, to use it to track where the economy goes. If you go to our fundamental drivers report, what we mentioned there was that recently, apart from we had a while where growth was doing okay in the Eurozone, despite the slowdown that we had, despite the war, despite all the concerns we had, growth was actually not doing too bad until the prior PMI print that we had, where we saw growth on a rate of change basis absolutely collapse. It was a huge miss that we had in the PMI data. Now, if you combine the PMI data to some of the signals which we were getting from other indicators, let me show you. We looked at this in a lot of detail, Abu. So you can just check the prior videos we did for more insights on this. But if you look at this, for example, we looked at the IFO business data, the IFO or the ZEW economic indicator, again, the ZEW data, looking at the IFO data, all of this was telling us, okay, the ZEW is very forward looking. That started to shift lower quite drastically recently. We had the IFO shifting quite lower recently. The reason why neither the ZEW or the IFO really convinced us of recession in the Eurozone was because those are obviously very sentiment based. So you would expect war in Europe to already see negative sentiment. What we were waiting for was the actual growth data to start turning around, or to start, it was looking actually not too bad for a few months. Then all of a sudden we saw those PMI data points coming out, and it just changed the cyclical view for the Eurozone completely, where just after that PMI print, we said, you know what, we think the narrative's going to change. The market is going to start pricing in a recession for the Eurozone, and we think that's going to lead to downside for the euro. And obviously, it played out well. We had a couple of really good trades on the euro with that in mind. So that's a good example of how you can use the leading indicators to tell you what could potentially be happening, how the markets could potentially be reacting. So we had the ZEW telling us downside. We had the IFO telling us downside. When those PMI data points came in, basically just solidified that view, told us, yeah, okay, the probability is definitely skewed towards a slowdown, and that's where the focus should be for the euro, and that's obviously why we tilted more bearish on it. So that's a very good question that you have there. So I hope that what I've shared now is helpful. Obviously, like I said, this is a very broad concept, right? I can spend hours and hours and hours talking about it, but we just don't have all of those hours to go through all of it. But I think that should give you a good basic idea, broad view of how we use these things, what they are, what the most important ones are, and just a quick example with the euro, how you can use it to find both short-term and obviously in the case of US equities to find medium-term directional biases.